freedom isn't the result of wealth, it's the foundation. Welcome to Wealth Independence, where freedom leads and real wealth follows through battle-tested strategies, hard-won lessons, and real-world experience. You'll discover how to accelerate your path to true financial independence. And now your hosts, Dustin Bailey and Adam Penn.
All right, welcome back to the Wealth Independence Podcast, where freedom leads and real wealth follows. And I'm Dustin Bailey, and I'm here today with Adam Penn. Hi, Adam.
Hi, Dustin.
A very nice color green shirt you're wearing.
It's Christmas time.
No, it's not.
Oh.
But it looks, and it's funny you mentioned that. Actually, the shirt that I'm wearing is kind of like Christmas colors. So
We could save this episode for December. It'd be awkward if one of us died between now and then.
well, that's isn't that one of the things they talk about with publishing content, that you can, your thoughts and everything just lives on past you? Like, isn't that a benefit? Well, anyway, how you doing?
I'm doing great. It's a new year, 2026.
We're recording this here in early 2026. I'm not sure when this episode will go out, but
I remember, what would have it been? November 11th of 2011, because my dad told me it was the last day in my lifetime that there would probably be all binaries in the number if you take the 20 out of it. I was born in 97, so I'd have to be 103.
yeah, to
So-
see it again.
January 1st, 2100.
I was thinking that there was this string all through the aughts and I guess the early 2010s where you had like one day a year was the 01, 01, 01, 02, 02, 02, and everyone was freaking out, and those dates ended up being a big marriage date. Wasn't it 12, 12, 12 was like the day that like the world was supposed to end, and there was
I watched the movie.
okay. Yeah, that
Was
was
the
it.
Mayan calendar ended?
Yeah, that's what it was.
I'm not super up on the times with that, but I was thinking maybe the dudes just got tired of chiseling into stone and we're going to add more when they got around to it, but it was like 1,000 years in the future, so it didn't seem important.
Yeah, they were just tired.
Yeah.
Oh, man. Well, that makes a great transition into our topic for today.
Because Robert Kiyosaki is old.
Sure. Actually, there's no transition whatsoever.
Okay. Well, sorry, Robert, if you're listening to this. I don't think he listens to our show, but we do know him. We've had dinner with
Yeah,
him.
Robert. Yeah, I had dinner with Robert in the middle of the Caribbean Sea. Caribbean
And in Orlando.
Orlando. Yeah.
And probably a handful of times in Dallas.
Robert's been very influential, at least in my life. I mean, that was one of the, everybody talks about reading the purple book.
The little purple.
The
They
little
say
purple
little
book.
purple book, not big purple book. It's that one.
Yeah,
there.
Rich Dad, Poor Dad.
Is that it? Oh no, it's this one here.
There you go. Nice. It's that one.
Yeah.
Robert's been very influential. And
Robert Kiyosaki, just to be clear.
Yes. Thank you. The author of Rich Dad, Poor Dad, and the author of several other books in the Rich Dad series, which, speaking
The
of,
cash flow quadrants are very good.
Robert's very well known. And Robert tweets a lot. If you're not active on Twitter, which it will forever be Twitter, I refuse to call it X. And it's not X and post, it's Twitter and tweets.
I think it's X and X's.
No, it's definitely
And
not.
when they do videos, they'll be O's, so it's X's and O's.
That's hilarious. I'll just give you that one. Anyway, if you're not on Twitter, you should get on Twitter because it's very interesting and entertaining. And you should follow Robert. Post some interesting things. Robert tends to have a very bearish view on a lot of stuff, and there's a lot of times he'll tweet several times a year that this is it, the crash is here, and it's finally arrived. And he's been tweeting that every year for the last 20 years. He's been saying it. Then once Twitter came around, he started tweeting it. But so there's some noise in his account, I would say. But there's some signal every now and then. And I think he posted something actually back in November that I thought would be pretty good for discussion, not only from what he tweeted, but what some of the replies. And I think a lot of people, especially if they're not familiar with some of the way he views things and what he teaches in his books, kind of miss the point. So we'll throw a link to the tweet in the release notes here. But he made a post. This was back in the end of November 21, saying practicing what I teach. And I think that's exactly what he's doing here. And he talked about he had apparently purchased some amount of Bitcoin for $6,000. He said years ago. I'm not sure.
About
And he
2019, 2018.
Yeah, probably based on that price. And he sold 2.25 million of it at around 90,000 at around this time. He says he's basically taking the cash and purchasing 2 surgery centers and investing in a billboard business. I thought it was funny how he wrote billboard. It's like the first name is Bill. Anyway, I'm assuming that's with Ken McElroy.
And probably Travis.
Probably.
Gordon.
But then he says that $2.25 million is going to turn into approximately $27,500 a month of income by next February. So we're, by the time this airs, he should be there. And he says tax-free. We'll take him on his word for that. But I know there's a massive amount of depreciation on the billboards, and then I would assume also on the surgery centers since it's real estate. They say, adding $27,500 a month of income to my years of previous cash flow, positive real estate math and cushion, the hundreds of thousands of dollars per month in cash flow is basically what he's saying here, and he's adding close to $30,000 to that. And then there's a lot of other content here that is somewhat irrelevant. But bigger point, when I read this, I took away, okay, he had been sitting on a lot of paper gains, equity, right? You can't eat equity. And I've known from being in the room with Robert, he would check the price of Bitcoin and would check his portfolio actually quite often, a lot of times, especially during times of volatility with Bitcoin. So I know this was something he was keenly aware of, but at the same time, Robert likes cash flow. It's one of the things he talks about and teaches. And this money was, yeah, sure, it's nice it's a great return, right? Buying at 6, selling at 90. But in the meantime, those numbers look great on his screen, but it was paper gains. And you can't eat equity. And so here he is taking a very significant gain and turning it into cash flow. And again, as he starts the tweet here, practicing what I teach. And I thought it was a great example of that.
Bigger point here is less than the gain, right? It could have been any, as one of the first comments says, you could have got a similar gain in the S&P 500, but the point here is not so much that, hey, I made this thing and it was a big gain. It was that I took the gain and I used that to buy cash flow.
Exactly. He did not just continue to sit on the equity to watch the number go higher. He saw that as a tool to purchase more cash flow.
Because once again, one of the beautiful things, in my loose math here says is about a 14% return that he's going to be getting on this. I think we happen to know that he traded another asset at the same time into this. So it's probably not, that it was probably more equity going into this deal than that 2.25 million in Bitcoin, but he was able to generate cash flow, and you still also get the appreciation, and obviously you're getting tax benefits. And as you would note here, if you got, let's just say the return was the same, about a 14% annualized return on the 2.5 million that he made, or on the Bitcoin, and a 14% annualized return on the cash flow, one is going to be way more tax advantaged, right? You're going to pay a lot of taxes on that Bitcoin, but on the real estate, you're going to get depreciation. You're going to get all these deductions from owning the building, and then you're going to get on the billboards. Obviously, you're getting depreciation and things of that nature. So it creates a higher return overall.
Absolutely. And to your point about taxes, obviously this would generate some sort of long-term capital gain, but we also know Robert owns a lot of real estate. He invests in real estate, invests in oil and gas. So I imagine he's gotten very adept at tax planning over the years. So I would imagine he planned for that. In addition to what came from this deal, which it sounds like here he's maybe going to use some of the depreciation from, again, the real estate and the billboards to not offset the capital gain, but offset the ongoing the tax implications of the ongoing cash flow. So really great example of this. I mean, there's a lot in this. And like, especially if you understand, again, what he teaches and kind of how the mechanics of some of this works, like this makes a bunch of sense. Like I totally get it. What was interesting, Robert, obviously, I don't know how many followers he has, if it'll show here. He's got 2.8 million. So he gets a lot of engagement on pretty much any of his posts. And I think this post in particular had 2.8 million views. But the very first reply I thought was interesting. I actually replied to it. You can see it here in the screen. But the guy calls out that $27.5 a month on a $2.5 million investment is 14.67 yearly return. Okay, that Adam, I think that lines up with the math you just did. Then this guy goes on to say the average annual return for the S&P 500 over the last 10 years is 13.8 to 14.7 when including dividends. And then the guy says, you can just buy an S&P 500 ETF and sleep well without worrying of losing principal. And I saw this and I just scratched my head and I'm like, first of all, is this guy like come on to some insight that I'm just unaware of? And the more I looked at it, I was like, no, he doesn't understand the difference between cash flow and equity.
He also, for some reason, thinks you can't lose principal in the S&P 500.
Yeah, so just completely ignoring that whole fact about like this thought that an ETF, you could never lose principal, right? The S&P 500 is never going to go down. I actually saw something. I think we'll end up doing an episode about this separately. Wall Street Journal had something recently, but they talked about that. Like, I think we're about to enter a year where there has never been, I think if the S&P 500 finishes 2026 positive, there has never been another string of years where it has finished positive that much.
Look at that comment there from Florida Man. Not that we just need to read Twitter comments, but the S&P has run hot for 10 years and the PE ratio is at an all-time high. Put your money in there. That was all quotes and then laughing.
He's paraphrasing this reply. Then he says, I can't stand Kiyosaki and I'm bearish on Bitcoin, but selling assets to throw them in the S&P 500 is a bad move, LOL. We can debate that, but I think you should probably be more concerned about near-term downside overall than if you're on a 30-year time horizon in the S&P, then it's probably going to be fine. But if you're on a 5-year, I don't know. I really think this line about without worrying of losing principal.
Well, I think a lot of that ties back to creating cash flow streams compared to just watching the number go up.
Exactly. And that's the bigger takeaway from this reply. I think it's a good example of how a lot of people think. And they're like, oh, well, you're only getting this much return from, that 27,000. That's what it's returning you per year. Well, that's only 14%. Well, if you just put it in the S&P, you'd get the same or maybe even more. And it's like, well, okay, on just a like percentage return basis. But one of those is paper gains. Like the return on the S&P is pure equity. Yes, the number goes up, but again, does it influence your life? You can't eat equity. And whereas the 27.5 here that Kiyosaki's talking about is cash flow, like that's cash money to his bank account that he can use to fund his life.
And the equity is still there. I think a good tangible example of this is we recently bought a building in Chico last year, and we are on track to spit off 5% annualized cash on cash return. We've done the first quarter distribution. Q2 is basically set up to be there, and then we'll see what happens in Q3 and 4. But 1.25% per quarter, that's 5% annualized. That means that the investors are getting 5% annual cash on cash return. This simplified engineer might think that's horrible because the S&P does 14, but these investors also got a 85% of the amount they invested as a deduction in year one that can offset this income. So now it's non-taxed. They are getting appreciation on the building. I personally believe the building's probably worth $200,000 more than when we bought it. If it were to be put on the open market, that's about a 35% return right there on equity. Obviously, that's once again paper gains. I don't treat that as a return, but it is in the same way that if the S&P goes up, it goes up type of thing. So there's a lot of different factors that when you look at all this together, it makes more sense than just trying to compare it. That's why it's hard to compare just stock market to just real estate. There are more things to analyze on a real estate deal.
100%. And the return on a real estate deal, your total return is a component of things, right? It's like the cash flow, but it's also the appreciation. You could factor in if you got any significant tax benefits, maybe that, if you want to factor that into your total return, that, how hard your money was actually working. But that was my big takeaway seeing this. I'm like, and obviously this was the top reply, right? It got 86 likes. 26 people bookmarked it. Like, there's a lot of people who think like this. And it's just, again, aside from the implication here that the S&P 500 is never going to go down, not understanding the difference between gains that are equity and gains that are cash flow, I think is crucial. And
you should set up a zap that the next time the S&P takes a 10% dip or something, or 8% dip, like a big dip, to automatically send this guy a tweet to reply to this
or something.
Yeah,
yeah, I might do that. Okay, well, I think we beat that tweet down. There was one other tweet I wanted to talk about, and this was not anything to do with Kiyosaki.
Similar mindset of living off of cash flow versus living off of principal.
For sure. So this was also from November, from a guy that I don't know this account. It's got 20,000 followers, says CPA and retirement planner. And this is not really the advice that I would have expected to come from someone that I would assume is a more traditional retirement planner, but I think it's really, really good. And it's something that I talk about a decent amount. I think most people don't think. So if you're watching on video, you can read it. But basically, he's telling a story here. It says, a retired pilot said, I'll just use the 4% rule. I asked, do you know where it came from? He didn't. And he talks about what the 4% rule, the 4% retirement withdrawal rule assumes. And if you're not familiar with this, it's a rule within traditional retirement planning that basically there was a bunch of research that says that if you withdraw 4% of your principal and you can live on that. So if we're talking $1 million portfolio, you can withdraw $40,000 a year. And in theory, in some sort of thousands of simulations, you never run out of money. If it's invested in a 60-40 portfolio, there's enough gains yearly to offset the withdrawals that nest egg never runs down. That's the theory. And again, you can run a bunch of simulations to show this. And this guy talks about here, he's fairly close to retirement. The market's at all-time highs.
He mentioned that his retirement, he's at 57, so he's talking about a 37-plus year retirement.
Correct. A long retirement, right? And that's the idea, is that using the 4% rule, you can continually withdraw from that nest egg. And it's the things we don't talk about. Things we talk about. You're having to sell assets and all that. But the idea is, yes, the nest egg gets smaller, but it ends up growing more each year than you actually withdrew. And that can fluctuate year to year. In the years that you have 20% gains and you only withdrew 4%, those make up for maybe some years where you actually withdrew more than it grew. And anyway, point being, if you're not familiar with the 4% rule, definitely encourage you to look that up more. But the idea is you can withdraw 4% in perpetuity, and the nest egg never runs out. But the thing that a lot of people miss with this is timing matters on that. And the year that if you backtest this, the year that you start retirement can massively impact the effectiveness of the 4% rule. And is what he talks about here. Retiring into a bear market plus withdrawing 4% equals permanent damage. And I think he gives some examples here. If you had retired in 2000, 2007, or even 2022, this guy who was looking at a 37-plus year retirement is now out of money by year 15, simply because you started taking withdrawals when the market was going down. You were retiring into a bear market. He says, he kind of concludes here, he, meaning this investor, the pilot, needs 40 years of money. The 4% rule wasn't built for that. And I think this is just a great reminder of, you can hear this advice in the 4% rule, and it's not bulletproof. And especially anytime that your retirement plan involves selling assets in order to fund your life, there's inherent risks with that. And especially selling volatile assets like stocks that can have really bad down years.
The S&P doesn't go down, I thought.
Yeah, exactly. If you ask simplified engineer, this is never a problem, right? The S&P is never going to go down. If you build a retirement plan around cash flowing assets, you simply don't have this problem because you're not selling the asset to fund your life. And so the valuation of the asset almost becomes irrelevant. As long as the cash flow is where it needs to be in order to support your life, you're good. And there's a lot of people who they'll get up in arms about this and contort themselves to try to show how this works, and it's really not that bad. But the timing matters massively in this when you're selling down assets to fund your life. So I don't know, Adam, you got any thoughts or anything else on this one?
No, sir.
Okay. We'll make sure we got links to both of these tweets if you want to check them out. We'll have them in the release notes. But that was really all. Those are the two things that I had on my mind for this episode. Twitter is just a continual source of. You can find a lot of bad financial takes on Twitter. So I don't know. Maybe I'll continue trying to find tweets to call out and say why it's wrong. Because again, a surprising amount of people. You had 86 people liked Simplified Engineer's tweet about the S&P 500 never going down. So a lot of people agree with that, and it's just completely wrong. Adam, any closing thoughts here as we wrap up this episode?
No, just that if people find this helpful, let's give us a 5-star review and like the things and subscribe and follow, and all of those things help get the algorithm out there so that we can continue to reach more people.
Absolutely. We appreciate everybody doing that. Well, with that, we'll get on out of here. Thanks for listening. Always good to have you. We'll catch you on the next episode. Just remember, where freedom leads, real wealth follows. Thanks, y'all.
Thanks for joining us on Wealth Independence. This show is for informational purposes only and is not financial, investment, legal, or tax advice and does not constitute an offer to buy or sell securities. All investments carry risk, and investors should always conduct thorough due diligence and consult with qualified professionals before investing. Until next time, remember, freedom leads and real wealth follows.